The first method to make money in the stock market is through capital gains. Now, the easiest one to understand is buy low, sell high. So you buy a stock at a specific price and you sell it at a higher price, and the difference is your profit. Let's say I bought Coke, one Coke share at $55. A week later, it goes up to $60. I sell it. I just made a profit of $5. It went from $55 to 60. I sell it. The difference, $5, that's my profit. Now, when it comes to capital gains, because the word capital gain is you buy the Coke at $55, it went up to $60. My capital gained in value. It went from 55 to 60. So I have a capital gain of $5. My capital gain is still something called unrealized if it's still trading in the market. Because when your investments are still in the stock market, they have the potential to go up, down, or sideways. Your capital gain, which is unrealized, becomes a realized capital gain when you sell your stock. The second method of making money in the stock market is through short selling or selling short. Now, this is the opposite of buy low, sell high, and this is more of a riskier technique. It's more of an advanced technique. Buy low, sell high, the opposite. With short selling, you're selling high and buying low, and the difference is your profit. Now, the tricky thing about selling short, because this of course is a risky method of making money in the stock market, at least with buy low, sell high, the only money that you can lose is the money that you have invested into the stock market. So let's say you invested $500 into the stock market, one company, and that company ends up going bankrupt. You only out that $500 that you invested. But with short selling, your losses could be unlimited. You were participating in short selling and you did a short sale on Coca-Cola. Coca-Cola was trading at $55. You think that Coca-Cola is going to drop to $40, so you can buy it back and make that profit. That between 40 and 55, that's the profit that you're making, that $15. But what actually ends up happening is that instead of Coca-Cola going down, the price actually goes up. So from 55, it's not going to 40, it's actually going to 60, 70, 80, 90. So as you can see, your losses are going to be unlimited because you still have to buy it back. The third way to make money in the stock market is through dividends. And this is more of a passive income method of making money. Companies, not all companies, but a lot of blue chip companies that are well established, they might pay out a dividend. Companies sell goods and services, and a portion of their profits, a portion of that net income, is distributed to their shareholders in the form of a dividend. This is also one of my favorite ways of making money in the stock market. And I have my own rules on analyzing specific companies to see how they pay their dividend and if they're increasing the dividend, because something that's extremely important to me is that companies that do pay a dividend, they need to be consistent with the dividends that they pay, and the dividend payment needs to grow faster than inflation year over year. That's a requirement that I have for these companies. So the fourth method to make money in the stock market is through options trading. Now, options trading can get a little bit confusing, but I'm going to try to keep it simple and explain it in a way that's simple to understand by talking about the call option method. Let's say you own 100 shares of stock in Coke. You bought Coke for $55. You're making money from Coke because Coke pays a dividend. They pay a dividend every quarter. So every quarter you're getting dividend checks, you're getting dividend payments. But you're not satisfied. You want to make even more money from your shares of stock in Coke. So what you end up doing is you end up writing an options contract. In that contract, you're pretty much saying that I'm willing to sell my 100 shares in Coke at $60. $60, also called the strike price. The reason why I say 100 shares of stock is because an options contract is usually a lot of 100 shares. Now, if the buyer of this option contract agrees with my contract, he has to pay me a premium. Now, a premium might be $1 per share on this options contract for Coke, for my 100 shares in Coke. Now, the premium could be influenced by a multitude of things. If the options contract is for a stock that is popular, it's gonna have an impact on the value of the premium. The closer the actual price of the stock is to to the strike price, that means that the premium is usually going to be higher. But let's stick with $1 for one share in Coke. And an options contract, it's a lot of 100, so we're getting a premium of $100 directly deposited into our brokerage account. So let's talk about how the seller is making money then. So I'm the seller in this case. If Coke, which I bought for $55, never went up to the strike price, the buyer is not going to execute the options trade, because why buy Coke at 65 when it's trading below 65? So I just made some additional money without even selling my shares in Coke, because I still own the shares and I made a quick $100. Now, even if the options contract did get executed, I would still make some money, because let's say I bought it at 55 and then the stock went up to 60 and it went past 60. The options contract gets executed and the buyer buys my 100 shares at $60. I still made a profit of $500 plus the additional $100. From the buyer side, I'm already $100 short. I'm already $100 in the hole, because I had to pay that as a premium to the seller. Now, if Coke never goes up to 60, I'm not gonna execute that options trade, because why buy Coke at 60 when it's trading under 60? But here's the cool thing. If Coke goes up from 55 to 60, I execute the trade and it ends up going to 65. Now I just potentially made $400 in profit, because let's look at this. So Coke went from 55 to 60. I execute the trade as the buyer, and then it goes from 60 to 65. Now I just made a $5 profit per share and I own 100 shares. So that's $500. It's still unrealized, of course, so I end up selling at 65. Now I just made a quick profit of $400. Why? Because that $500 minus the premium of $100 gives me that $400 in profit.